camera. Just
Okay.
shout out if you need anything.
So thank you so much, Anand.
Yes, sir.
Recording in progress.
Good afternoon, everyone. I'm Tirthankar Patnaik. Thank you for joining us for the day's NSE ISB webinar on investing and financing opportunities in sustainability. The concept of sustainability has gained immense prominence in recent times, especially after the onset of the pandemic. The COVID-19 crisis was also termed 21st century's first sustainability crisis, and it has renewed our focus on ESG issues and prioritized the adoption of a more sustainable approach to investment. Today's webinar is being organized under the aegis of the NSE ISB Trading Lab. This trading lab was set up in the year 2014 with the aim to pursue research and promote policy dialogue in the area of securities trading, investments, and financial markets. The trading lab has made significant progress in unexplored research avenues in capital markets, corporate finance, asset pricing, etc., largely focused on the Indian financial markets. The trading lab has also produced several, and I mean several, high-quality research papers, some of which have been published in reputed international journals, such as the Review of Financial Studies, the Review of Finance, and the Journal of Money, Credit, and Banking. I would now invite Mr. Ravi Varanasi, Group President, NSE, and Chief Business Development Officer, to deliver the welcome address and start today's session. Over to you, Ravi.
Thanks, Tirthankar. Professor Rajgopal, Tirthankar, ladies and gentlemen, good evening to all of you. I extend a very warm welcome to Professor Shivaram Rajgopal for accepting our invitation to share his thoughts with us on this important topic. Obviously, this is a relevant topic, as Tirthankar has mentioned. Investing based on environmental, social, and governance principles has been gaining immense prominence across the world in the last few years. This can be attributed to heightened level of awareness among investors and the commitment from the corporates. Countries, obviously, all of you are aware, almost all countries have been kind of committing to net zero emissions over the next 20, 30, 40 years. Hopefully, we are progressing in the right direction. In addition to the traditional metrics, the ESG mindset of corporates and their outlook towards sustainable development of the environment and society they operate in have become key factors in determining long-term growth trajectory of these corporates and wealth generation for investors. Investors are keenly looking at some of these specific metrics while taking their investment decisions. The theme of investing in sustainability has not only gained traction among institutional investors, more hearteningly, even the retail investors are catching on to it and are trying to figure out, because particularly the millennials have been clued into the environmental issues, and they're getting clued into these areas, and they're far more swayed by corporates which are possibly seen as ESG compliant. So that is an added additional requirement or an additional issue which corporates have to take into consideration while determining their own policies. So that is an important aspect which is really driving investment decisions, not only from institutional investors but also from retail investors. It is imperative that companies integrate their ESG policy into their day-to-day activities and strategies, which can go a long way in demonstrating their commitment to stakeholders, which will reinforce some of the investment decisions which some of the institutional investors as well as retail investors are going to take. Taking into consideration how availability of data or information around ESG has become increasingly relevant for financial markets, SEBI has recently introduced new disclosure norms, all of you are aware, on sustainability-related reporting. For the top 1,000 companies, this is the Business Responsibility and Sustainability Report, which is voluntarily currently at this stage, but will go mandatory from FY23. The new sustainability reporting standards are expected to provide greater transparency in the disclosure of ESG-related information, which incorporates all metrics to measure, among others, material environmental risks and energy consumption, etc., which will give the investors additional information which to make their informed decisions. At NSE, we have always encouraged initiatives relevant and emerging issues that motivate corporates to enhance their business practice, enable policy dialogue among the regulators, and strengthen market integrity. We have launched NSE Prime yesterday, which is a step in this direction. The idea is to incentivize corporates to adhere to higher standards of governance compared to what is prescribed by the regulator. NSE Prime has put in place a particular framework which is a notch above the current regulatory framework requires, and it is voluntary at this stage. We expect corporates to try and up their game as far as the ESG and the corporate governance areas are concerned. We're also, our data company and index company have been consistently working in this direction. They have been coming out with indices which will help investors as the aim is to come out with funds and investors to invest and track those funds far more efficiently. We have an international exchange in our GIFT city. There also we are trying to do a series of activities on ESG side. The regulator there obviously is trying to publish their own set of metrics and monitoring mechanism. We're trying to actually bring out a platform which will enable corporates to actually measure and monitor their own ESG journey as they embark on this particular journey. So these are some of the initiatives which, as an NSE group, which we are taking, and hopefully we will be able to contribute our own in our own way a little bit towards the ESG journey as we go forward. The overarching theme for today's webinar is how ESG can help businesses and investors become resilient and achieve their long-term goals. We are honored to have Professor Rajgopal, who has extensive experience in this area. And I don't want to really waste too much of time. We'll straight away go to him, and I hope and wish that you all get some important takeaways from this particular discussion. Over to Tirthankar and Professor Rajgopal. Thank you very much for joining us today.
Thank you, Ravi. Let me now take the opportunity to introduce Professor Shiva Rajgopal, the guest speaker for today. He is the Kester and Byrnes Professor of Accounting and Auditing at Columbia Business School. Professor Rajgopal's research interests span financial reporting, earnings quality, fraud, executive compensation, and corporate culture. His LinkedIn handle reads Investor Advocate, and his research is frequently cited in the popular press, including the Wall Street Journal, the New York Times, Bloomberg, Fortune, Forbes, Financial Times, Business Week, and The Economist. He teaches fundamental analysis of financial statements for investors, managers, and entrepreneurs, and a PhD seminar on accounting regulation. Professor Rajgopal is the departmental editor of the accounting track of Management Science, a very reputed journal. He is also an associate editor at the Journal of Accounting and Economics and an ex-editor at Contemporary Accounting Research. He was on the editorial board of the Accounting Review from the year 2003 until 11. He's won several awards, which include 2006 and 2016 American Accounting Association, notable contribution to the Literature Award, the 2006 and 2016 Graham and Dodd Scroll Prize given by the Financial Analyst Journal, and the 2008, 2012, and 2015 Glenn McLaughlin Award for Research in Accounting Ethics. Professor Rajgopal, it's a pleasure to have you here, sir. It's really a pleasure.
Thank you. The pleasure is all mine. बहुत ज़्यादा introduce कर दिया यार. So I hope I live up to that billing. So thank you, Ravi, and thank you, Tirthankar. I'm a lifelong Bombayite, so it's my absolute joy, at least virtually, to join you from Coimbatore. I wish we were all in Bombay, but hopefully next year. So thank you.
The pleasure is entirely mutual, sir. The pleasure is entirely mutual. Hope when things become normal, we do get the opportunity to host you at Mumbai here.
You just have to, just drop me a one-line email. I'll be there.
Thank you, sir. Thank you.
Especially my daughter never misses the opportunity to visit Mumbai. It's her favorite city. which you may have a hard time believing, but she likes it even more than New York.
We hope the stars align soon, sir.
No, it's great. It's entirely, yeah. So happy to help in any way I can. So let's chat here.
Let me go to the questions. So then let me begin with my first question to you. It's been argued that if every person were to consume like an average person from the developed world, we would need many Earths worth of resources. Sustainability in that sense also means aversion against consumerism. How do you think this would incorporate into value for a sustainability research investor who's also looking for growth?
So, so let me start with what might seem like a digression for a minute, right? So, Econ 101, if you think about that, how do we add value? So it's some combination of materials, some labor, some capital, and some managerial talent. There's also a fifth factor of production, which I think we've, at least till I started working on this, I think we had almost forgotten, which is natural capital, right? So we assume that water's free, carbon's free, the natural capital is just there to be exploited and taken without the need to account for it. So maybe that's one way to frame the whole conversation. So, this degrowth idea, right, which is what you're effectively alluding to. I know many prominent people subscribe to that. I just find that very pessimistic, degrowth. I mean, you can't go to the developing world and say we should believe in degrowth. It may be fine for Europe, it may be fine for the US. Even there, I'd suspect that this degrowth idea doesn't really have a lot of support. So maybe the savior here, hopefully, is technology. So if we can figure out a way to keep the GDP growth the same or higher, maybe by consuming less of the natural capital, perhaps through better technology, whatever that might be. It can be nuclear, it can be electric vehicles and so on. Maybe that's the way out. I just find this whole idea, the whole Malthusian notion that there are too many people and it's all gloom and doom, just a bit pessimistic and probably not even helpful. And you cannot, with a straight face, go to somebody in India and China and say, that's the end of growth. That is horrible, right? And since I've been lucky enough to at least look at both systems a little closely, both US and India, I personally find that whole suggestion very problematic. That that's the end of all growth. And consumerism may have a negative connotation, but the flip side to that is just GDP growth, right? We all want better lives as human beings. Otherwise, why should I get out of bed in the morning? So hopefully these are not mutually incompatible. But having said that, if you start pricing in natural capital, suddenly, the whole paradigm of valuation and fundamentals completely changes. So I did a piece, I can share that with you later if you like, on Coca-Cola, just as a case study. If you just assign very modest prices, and this is where it becomes complicated. What is the social value of carbon? What is the social value of water? We can have conversations about that. But even at very modest values assigned to these things, like the social value of water, for instance, Coca-Cola produces 165 billion liters of drink a year. It's a mind-boggling statistic. 165 billion liters. There are 8 billion people on the planet. So the per capita consumption of sugary drinks is probably like 20 liters. That is huge. So a lot of water is used. They are the largest producer of plastic bottles. 60% of that is probably recycled. The rest is not. So if you start assigning a price to emissions associated with production of those bottles, and if you look at water, this is just water drawn. Let's not forget that they use beet and sugar, which also tend to be very heavy in terms of water usage for irrigation purposes. So once you start putting prices on all this, their net income just vanishes, by the way. And I fully agree, that these are like iconic companies that support so many jobs in the whole supply chain, that support taxes, but it is useful to understand the price that we are paying to support these jobs and support these taxes. So, if nothing else, I think this whole ESG movement has, at least I think, focused on this probably undiscussed unpriced natural capital idea, and the fact that we simply need to do better, more growth, if possible, at least maintain the same growth with less consumption of the natural capital. So hopefully that's a way to reconcile these approaches.
I have several segues on the first question per se, but the Malthusian hell, in some sense, people are seeing the other side of it, right? The total fertility rates in India, China have sort of gone down meaningfully.
Yes.
China is already below,
replacement.
Yes, and India is getting there. So, this idea that technology can actually move us to a utopian world rather than a dystopian world. How you seem sold to that idea, Professor?
I don't think we have an alternative, right? What is the alternative? The alternative is that we all get depressed and do nothing. But even if you look at history, Tirthankar, I mean, isn't that borne out by the evidence, right? So, for instance, something like rare earth was just useless a while back. Even petroleum, if you go back maybe to the 1800s or so, was probably was viewed as a nuisance before we found a way to use it in a constructive way. I mean, look at lithium and cobalt, the fight to get to those, because as you know, they are used in the batteries for the EVs.
Yeah.
So maybe there are ways that human ingenuity can unlock of solving these problems that we are not even aware of today. So if you look at the history of capitalism broadly defined, you can cut it various ways, but an optimistic way to cut that whole history is, it's all technology.
Yeah. Hope springs eternal in that sense. I couldn't agree more. I mean, people were burning whale oil for lights just 150 years back, and see how things have changed. There was no electricity even 250 odd years, and today we can't live without it. We take it for granted. The technological revolution, and especially in some sense, the way things have changed in the last several decades, right before us, it's a fond hope. Somehow one does not see that coming out of COP26 discussions. One sort of gets a sense that we if we don't do enough, if we don't do it now, then we are living in a probably a world which will have mean temperatures more than 2 degrees above pre-industrial levels. Do you think enough is being done on that space?
Well, that's a great question. I think I mean, I'm no engineer, as you discovered from my introduction. But if you talk to the climate scientists, at least at Columbia, they say that 2C is already done. We are beyond 2 centigrade. So a lot of this is just sadly posturing, and the whole Paris Accord, the whole Glasgow thing was a faint attempt to get to 2C. 2C, at least I'm told, is kind of done. So you're looking at something potentially, sadly, worse. Now I guess the bad news starts, right, of the webinar. So apparently, I'm sure you've seen this, but apparently the carbon budget that we can, as humanity, burn is roughly at current rates 10 years. Before we breach 2C. So is enough being done? Again, complicated question, right? I mean, so after the Paris Accord, Europe effectively made life for energy companies quite difficult. So many of them just came to the US. They outsourced a lot of production. So 85% of the output and emissions come from Asia. So just because you've kind of outsourced the problem to someone else doesn't mean that we are doing fine. So it depends on whose perspective. From an Asian perspective, since 85% of the output of the world comes from this region, it's a huge problem, right? And it's to a great extent a local problem. I mean, it's a global problem for sure. So what's the way forward? Maybe one just has to adapt. There are dire predictions that all the 3 airports in the New York area will be underwater. Maybe in about 30, 40 years, Miami will go underwater. And I'm sure there are people who probably predict fairly serious things for Singapore, Bombay, Calcutta, and the like. What's the way forward? So one has to invest a lot just in adapting as well, and there are huge opportunities there. Yes, it's going to involve a massive influx of capital, which I think is not appreciated enough, especially at the municipal state sovereign level, because all this probably has to come from the state. It's pretty hard to expect the private sector to go rebuild roads because of climate change issues, or resettle large cities which might go underwater.
I couldn't agree more.
Yeah, so there's a lot there which we haven't appreciated enough. So it has to be some adaptation, some eureka moments of ingenuity to get us out of the mess. So is enough being done? Perhaps not. Not in the US for sure. My worry is that we will end up doing nothing. We will not. The politics is quite dysfunctional, as this is public knowledge. So a basic carbon tax probably won't go through, etc., etc. So it's frankly up to the private sector. So this is the other reason I think why this whole ESG thing has become such a big deal, especially post-COVID. To some extent, maybe after the previous administration, at least among certain portions of the electorate, the confidence in the government has kind of fallen. So people are looking to the private sector, which they may not be ready for, as maybe the saviors, the beacons of progress, the adults in the room to help bail us out from some of these big problems. So maybe that's why this whole conversation about business and society, social responsibility of business, has become such a big deal in the last 4 or 5 years. So it's this whole topic is highly political. You can't get through the conversation about ESG for 10 minutes without somehow talking about macro policies and politics, especially.
Because it affects people's lives, right?
It's massive. It's huge. It's to some extent. I was just digging up some statistics trying to prepare for this webinar. Going back to our favorite city, Bombay, Mumbai. They say there'll be 25 million people by 2025 and 42 million by 2050. It's a mind-blowing statistic. Even now, I think it's like 20 odd million people, right, in Bombay. 20 million people. The state of Florida has 9 million people. Just to put it in perspective, the New York area has probably 20 million people. The whole MSA, which is the tri-state area and so on. It's a very densely populated area, but that's a lot of people. So a lot of work probably has to go into urban planning. Where are these people going to live? Where is the water going to come from? Everybody is proud of their newly acquired car, motorcycle, but what is that doing to the AQI? How do we get people out into EVs? The cost of producing that has to either plummet or it has to get subsidized. How do we make sure the subsidies go into the right hands and don't get abused? Lots of big, important decisions to be taken, and simple measurement tools. Something that we were chatting about before the webinar began. Just tracking AQI, good measurement. Ultimately, hopefully, will change hearts and minds. Maybe that's where whatever little I have to contribute to the debate, it's by being an accountant. It's about measurement. So some big decisions to be taken.
The tri-state area is 4 times the size of the Mumbai metropolitan area. More than 4 times. So if you
in terms of GDP, Mumbai, I was shocked. It's 2/3 of India's GDP. The tri-state New York area. That's partly because of finance and so on. But that still tells you, keeping resources constant, you can still do a lot. In terms of, maybe the denominator is constant or lower. If you think of natural capital or resources as a denominator, but the numerator in terms of, gross income, GDP could be higher. It has to be higher. I don't think we have a choice. The other vision is just far too destructive, dystopian to even entertain for more than 5 minutes.
If we let, you mentioned the private sector. I would just add that, in terms of acknowledgement, before I go on to my next question, in terms of acknowledgement, it's the commissioner of the city, in Mumbai. I'm in Mumbai at the moment. who mentioned that large parts of the city could come underwater in the next several decades. So the acknowledgement is there. There is awareness. And on that note, if I move to the other point that you made about the role of the private sector, the entry of the private sector and the entry of investment into this sector go hand in hand. So my next question has something to do on that topic, Professor. It's on investment. What do you think would be the principal motivating factor for someone to invest in sustainability? Is it the inevitability of environmental shocks, as you just mentioned, or that society would turn around and cooperate towards building a more sustainable planet? And just to put some meat on what we are saying, what time spans are we looking at?
Okay, so many questions there. So, is it the inevitability of environmental shocks? To some extent, yes. There will come a point in time where, this has already happened in Beijing, right? They couldn't see the sun. So a lot of the expats started leaving. People said enough is enough. So once you start losing people, and by the way, a lot of these losses happen, except that they are not visible. There was a RAND study which said that China's pollution causes losses of roughly 7 or 8% of GDP, which I'm guessing is actually understated. So some of it is visibility. These losses happen. Yes, there may be social losses to some extent that has to probably be fixed by the government, but it can't be cash transfers. You have to stop these somehow. That's where the private sector can jump in. There are so many opportunities, right? All these things that we discussed, battery technology, that's a huge positive. Is there a way to probably generate as much or more power with less coal or less fossil fuels? Again, where is the innovation? Where is where are the future advances going to come from? Private sector. In fact, to the point, as you know, Tirthankar, there actually might be a green bubble. The valuations for some of these green technology companies now like skyrocketing, right? But you also make a very good point, and this happened last week. For example, Citibank started this whole fund. You must have probably read this in the newspapers, where the idea was to raise money and use that money to close down the coal plants in the US. And obviously, it didn't go anywhere. You can't offer zero return, a negative return, like negative 100% return financially on your investment. So we have to find some buyer media. And you also mentioned the millennials. Half the reason I stopped everything else and kind of started concentrating purely on ESG is the zeal that our students have. These guys are the future voters. They're the future politicians. They are the future citizens. It is not long before maybe India and the US have a green party. Because some of it is going to be regulatory pressure. Because it'll just become, untenable. If farmers can't grow as much a crop as before, if cities are underwater, if people are choking under the haze and smoke, etc. So there'll be social pressure for sure. That is undeniable, especially in India. It's very visible, right? In the West, it can be a theoretical conversation. It may be an inconvenience. It's an existential issue in the East, partly because our area produces 85% of the output and the emissions. But where is the money to be made? I think that it's a polite way of asking. That's what you're trying to hopefully ask. But there is money, A, in responding to these issues, B, in green-friendly consumer products. That has to be a huge area. It already is. Organic food is very big in the US. It was virtually non-existent 15 or 20 years back before Whole Foods came in. Chemical-free anything these days it's important, because I think we have messed up our supply chains, especially food supply chains and so on, to such a point where that's why the people have so many uncatalogued diseases, immune issues. It's very common in the US. For example, I have so many allergies. Why? Because I'm basically in an environment where I did not grow up, so all the probiotics in my gut are different, and frankly, the food supply chain in the US is a mess in terms of it's highly chemicalized because trying to raise productivity and so on. All these are opportunities. Organic food is very expensive, 3x, 4x, 5x of the regular food. Margins are bigger. right? So there are, it would be, odd to. I think there'll be no industry that is not touched by this movement 20, 30 years out. And even if the politics is a mess, I think it's an organic movement. People want it. There's consumer demand for it. Sunset industries do have an issue, like oil. I mean, I just posted a piece on Forbes where I try to make the point that look at tobacco. Tobacco, especially Philip Morris, has done a fantastic job in repositioning itself for the new world. For example, New Zealand has banned the sale of cigarettes for anyone born after 2008.
Yes, people have not taken kindly to it. Yes.
But it's interesting, I mean, New Zealand, of course, has always done fascinating things. Even in the world of accounting, it's the only country in the world that follows accrual accounting, by the way, for sovereign financial statements. But setting that aside, New Zealand is a leader. So where are we going with this? You have to adapt. And PMI has done an excellent job. They've talked about the smoke-free future type idea. So there, everybody talks about corporate purpose these days, but I think it's a case study worth understanding. If you're running an oil major, look at how big tobacco has managed this, especially PMI. If you think that sustainability is a value that's imposed from the outside by other activist funds like Engine Number One, or maybe a few disgruntled social investors, you'll never internalize this in your business model, and if you don't internalize it, you're going to get all the usual issues. It'll spin, greenwashing, etc., which we see a lot of as well. Partly because people don't think it's incentive compatible, which is your point we made earlier, right? Why is it incentive compatible for me to do all this? Meaning, how do I make money on this? The whole classic tension between shareholder and stockholder, the stakeholder and shareholder capitalism, which I'm sure you've read a lot about.
Yeah.
But if you don't, there are lots of business transformation cases waiting to happen. There are industries which will have to adapt eventually. Yes, the reporting is a mess. It's early days. The sustainability reports are like, probably have more pages than the proxy statement and the 10K combined sometimes. But eventually we'll kind of converge and settle down. But the underlying business trends, especially the opportunity to make money, has to be there. That is the future. Sorry.
Have we moved permanently away from Friedman in that sense?
It's a fascinating debate. I don't know how many of your audience members are interested, but we can talk a lot about that. Friedman's a piñata, right? It's a straw man. I mean, he never said all the things that people claim he said, right? He basically said you have to obey the law. He did talk about social license. And he was basically saying that if you're doing funny things as a manager, right, using corporate resources to further your own goals, that's what he was against, which is classic agency, right? Diverting resources for your own selfish goals.
Yeah.
Is this whole stakeholder idea incompatible with Friedman? Not really, because how can not taking care of your employees be important to shareholder value? It has to. How can not treating your suppliers reasonably be unimportant to shareholder value? It has to be. So as long as these values converge, there's no conflict in my mind. The issue arises, as you probably are going to ask next, what happens when there is a conflict?
Yes.
Right? And there, the way to salvage that conversation maybe is to distinguish between long-term and short-term value. Because probably in the short run you can get away by screwing with your customers, but in the long run, assuming there is reasonable entry, which is where the political economy comes in, right. Somebody else will hopefully come and take those customers away from you. Tastes will change. The whole green eco issue that we discussed, or organic foods. So the market share for the existing crowd will go down. Or you'll segment the market in such a way that they have low margins and you have higher margins. So it's not as, to me at least, the Friedman conversation is overdone. But you're right. I mean, there are cases probably where so-called stakeholder capitalism is a problem. I'll give you an example, right? For instance, if you're General Motors and Mary Barra, the CEO, you're trying to shut the plants that make the gas guzzlers in Michigan, and you're trying to move them to the south, where you're going to make electric vehicles.
Mhm.
How do you decide? Because if you talk about this world of stakeholder capitalism, if you're talking about shareholder capitalism, if you think EVs are the future, you should just shut your plants in Michigan and go to the south and build EVs, which require fewer people, by the way, because they're more robotics heavy. But if you get into this world of stakeholder capitalism, if you shut the plants in Michigan, you're going to screw those workers. How do you decide whether the workers in Michigan are more or less important than the workers in the south? Don't know. That's what Friedman was complaining about, right? Because it makes the CEO's job infinitely complicated, and it gets to a point where the CEO is accountable to no one. Because you can always say, I did better by this stakeholder group or that stakeholder group. You saw this a little bit when the known CEO got fired by the activist investor because he was a pioneer. He actually used to put out carbon-adjusted EPS numbers, but conventional stock price didn't go anywhere. For instance, Unilever is an example. Paul Pullman, who gets discussed a lot, poster child of this whole phenomenon. If you look at the data, it's quite interesting. You can easily probably entertain an alternate hypothesis that a lot of Unilever stock performance became better after an activist came, which is classic shareholder capitalism. The activist comes in and says, look, you're not doing a good job with capital allocation or returns. Maybe you should just either return capital or hand over the reins to someone else. So even there, this whole stakeholder shareholder dichotomy is overdone, and I'm beginning to think not even helpful. I mean, I wrote a piece in the context of Unilever where I make these points. For example, after Pullman left office, when the returns were great and so on, but the number of people working for Unilever shrunk. Is that good stakeholder capitalism? I don't know. Maybe you should have more people, right? So anyway, I don't want to belabor this too much, but I'm happy to talk about this if you like. But to me, that whole Friedman, anti-Friedman conversation is a bit, I don't know. I think it's overdone, let's say.
I think in terms of awareness, in terms of how people are coming up to speed on this, it's been a decade or less, right? People had still questioned climate change. And all of a sudden, I asked you about time span. That the sense
I didn't. I can address that if you like. Sorry, I was not trying to punt that question. Time span is a fascinating problem, frankly, especially in the world of climate, right? So I think Ravi talked about net zero pledges. Many of these companies are talking about 2050.
Yeah.
Now, 2050, even if you're an oil company, is 4 CEOs away, assuming the average tenure is 7-8 years, and maybe 4 boards away.
Yeah.
So effectively, probably a generation away, if you think your average working generation spans 30 years. So who's going to keep these companies accountable for those pledges is an interesting conversation. So I'm thinking you almost need something like the Federal Reserve in the US, which is an intertemporal, meaning across time agency, which is somewhat reasonably apolitical. Nothing is totally apolitical, but you want something that's reasonably apolitical. An something like a climate Federal Reserve that will hopefully track these things and keep companies somewhat accountable and honest. Because it is a huge problem. It is fairly easy to go ahead and make a statement saying that the 4th CEO from today will take care of this for me. So obviously, if you're looking at accountability, you have to look for transition pathways, right? What are you actually going to do in the next 3 years, 5 years, 10 years, 15 years to get to this vision? And it's still difficult because technology is evolving. Carbon capture may be successful, may not be. The whole offsets idea, buying for forest credits in Indonesia has huge verifiability issues because they're probably selling the same forest to 10 people, et cetera, right? But time span is a especially in that context is a huge issue. In certain other contexts, time span is right now. We're all desperately trying to find a better battery technology, for instance. Is that what you had in mind when you refer to the investing time span?
Indeed. But to take up what you just said, yes, a state in our system is a permanent entity, and your representation of the state in the form of, say, a Federal Reserve or a climate federal initiative. The question I have is that the problems they have are also a little, something to do with policy, something bigger, which are probably beyond the pale of a single private, enterprise. Let me just give you an example in this, and would love to hear your thoughts. In India, we have, this move towards EVs. We did discuss in our conversation how, we would like to move towards EVs, but India has a very thriving internal combustion, an IC ecosystem, something that's done well, especially, the ancillaries, the auto ancillaries in India are making a mark sort of worldwide. And if we think in terms of moving from an IC ecosystem to an EV ecosystem, this is a bigger policy debate, right? It's not just market initiatives, but it's also something that has to be thought at a state level in terms of how one should help the EV ecosystem, but also sort of think about what to do with the existing IC ecosystem. What are your thoughts?
Oh, it's a huge problem. There's no question, right? Especially because replacement cycles for cars are 11 to 15 years out, right? So anything you talk about today, even if you decide today to change everything, it's a 20-year transition. Mm-hmm. And the longer we postpone this, the harder it becomes, right? But, Tirthankar, the private sector answer to this, as you know, is a carbon tax. I know oil is very expensive in India because we import a lot of our oil. Yes, ESG, if done right, is frankly inflation. Because if the carbon tax gets just passed on, it's going to ripple through the whole system.
It is.
But it goes back to my, first comment about natural capital, right? They're not pricing that. The IC system is great, yes, but at what cost? Right? It's being socialized. The carbon cost, which is inherent in a car, and when we drive or do whatever, all of us are paying for it, and it was fine for a while, but it's getting to be a problem, right? So I think what you're asking is, will the private sector on its own switch to EVs? Not unless consumer demand changes.
Exactly.
And this is the issue with oil. We can say all we want. It's like tobacco. We're all addicted to oil, and unless there is some demand replacement / management idea, and frankly, some of that has to come through regulation. There is simply no other way. It is always going to be, this is a short run, long run conversation we had, always in the short run going to be lucrative to stick with what we're doing well. Right? So it has to be a partnership between the state and firms. Subsidies have to play a part. I don't see any other way out. Which is my earlier conversation about subsidies. Maybe we find ways to transition some of these companies to the other world. Otherwise, right? I mean, we're already looking at 200, 300 AQIs.
Yeah, that's the problem.
20 years, it's probably just going to get worse, right? If we keep investing in this IC stuff. So either it has to be a carbon tax or some partnership between the state and the private sector, and or some subsidies-based arrangement to transition. I don't know what else one can do.
From an accounting perspective, sir, you mentioned how we should start factoring in this cost that we have sort of taken for granted, this idea of natural capital. Will this sort of help us see the problem of ESG? So there are people that are still not convinced with the ESG idea. The requirement is there, the importance is there, but people, the naysayers, sort of look at it this way. An ESG mandate is a constraint optimization problem. You have a current corporate that's working, its best to do shareholder maximization and therefore keep people happy. There is an awareness that stakeholders are also important, and you have to look at both sides. But an ESG, a corporate that follows an ESG mandate versus a competitor that doesn't, you are in some sense looking at a constrained versus unconstrained optimization problem. Will bringing in the concept of natural capital help us understand this better?
I think so, right? I mean, so wherever I look, I'm beginning to get convinced it's a fairly big omitted variable. You know, we have not perfect, but at least reasonable ways to measure the cost of materials, labor. Managerial talent is a bit more complicated. The best we do is maybe management compensation. India, the other added reality is that most companies are family-owned. So you have to somehow price that control issue, right? Because it's very hard to dislodge some of these owners. And once you throw in natural capital, I think the whole conversation changes, right? Very reasonable lower bound estimates. There will always be disputes about what is the social value of carbon. Is it $50 a ton? Is it $100 a ton? Maybe carbon markets will provide an answer, maybe. And you can extend that to water and so on, other issues too, broadly speaking, natural capital. Maybe that's one way to. So you're saying that there's a competitive disadvantage, right? If I suddenly want to become ESG and my competitor said, screw it.
Initially.
Yeah. So that's where measurement and accounting systems can really help. This is one of those many cases where accountants can save the world. But this is surely one case where that's an important issue. The naysayer point you made, right? People are not convinced. It's true, I mean, I've spent 5-6 years thinking about this problem, and I was I was a naysayer for sure. I said, this whole thing is a fad. It's like whatever. But the more I think about it, the natural capital idea made me a bit of a convert. Because I'll send my Coke case to you, and you can rerun this. For example, here is what I did. I started with the Coke's ecosystem is actually very messy, by the way, because they have people who, first of all, their organizational form is complicated. They sell syrup. They do a little bit of bottling inside, but there's a massive ecosystem of bottlers which are technically outside, but actually it's part of the ecosystem of bottlers. So if you kind of put everything together, you have to sort through a lot of numbers. I still don't know whether I have everything perfect, but it's overwhelmingly large. The cost of natural capital that they ignore, and if you're willing to entertain a little bit of a broader definition, the incremental diabetes cases that get cost. Before the call, we talked about this. They produce 165 billion liters of drink a year. 165 billion liters. There are 8 billion people in the world. So the per capita consumption of Coke is like 20 liters. And in certain countries, 4 countries, I couldn't get data for India and China, where diabetes rates are actually very high, as you know. But in the US and especially Mexico, it turns out there are places which consume more than 127 liters per capita per year, and that's apparently the cutoff for diabetes. So these costs are effectively being socialized by the healthcare system, right? Who's paying for this? The Mexican taxpayer. It's a very complicated reallocation problem. But if you put everything together and start putting some prices to the negative and positive externalities that companies create, they create jobs. Let's not forget, they pay taxes. For example, in the tobacco industry, at least I looked closely at PMI. For every $1 of revenue that PMI takes in, which is Philip Morris, 60 cents goes to the government. Amazing. I've never seen a business where you book revenue of 100, 60 is paid as excise, 40 is your net revenue. So this natural capital measurement idea, maybe just to close that point out, I think has a lot of potential. I mean, we've assigned it. The cost cannot be zero. There is a cost. Now you may have a quarrel about what those costs are. The way to settle that is to start with some ranges. And sadly, to some extent, that has to come through regulation. There aren't as many enlightened, voluntary businesses that will internally disrupt themselves. I mean, look at oil, for instance, coal. Frankly, if you run the math, it is cheaper to, pay every coal worker in the US $50,000 a year for the next 10 years, not to come to work. It's not a lot of money. Seriously, just shut the whole thing down, pay them a lot of money, and move on. But for narrow political reasons, that won't happen. So it's a classic tussle between the short term and the long term, classic coordination problem. It's the tragedy of the commons. So, how powerful is the investing community in resolving all this? So there's a lot of controversy about that as well, as you know, which is partly the naysayer issue, saying, what can you really do? Maybe, but I don't know whether we have too many options. The pressure has to come from somewhere. Maybe it's the next generation, the Greta Thunbergs of the world. Maybe the investing community can do what it can. Frankly, things like divestment don't, in my mind, do anything. You can, as a fund, let's say you don't hold tobacco. They don't need your capital. The retained earnings are so high, they can finance growth, and they're not growing anymore. Oil, yes, I hear some people saying that the cost of, the cost of capital, at least the thresholds have kind of gone up to like 20 or 25 odd % in the US, which is very high, as you know, because the 10-year treasury basically trades at like 1.5%. The yield is tiny, it's almost free. So maybe on the margin, some of those things work, but divestment doesn't work. You have to engage. And, even if just to kind of go on with the oil example, let's say we tax the Western oil majors to death. What will happen? Effectively, the state-owned enterprises will make oil, and they are untouchable. The Aramcos and the Rosnefts of the world. So it is not in our interest to get these people shut down. It is in our interest to engage, to some extent help, cajole, subsidize, yes, as well, because this is probably a place where public money is well spent. I'm also a very serious skeptic. Let me warn you, just to clarify. Will the state use tax as well? That's a huge concern. The temptation to piss the money off, etc., is always very, very strong. But going back to the practical issues that we discussed, I don't see a way out. Some subsidization has to happen with hopefully a lot of safeguards, scrutiny, and transparency. Otherwise, we're all facing, I don't want to sound scary, but collective Armageddon.
If I look at push, away from the state, if I look at push from investors, if we've had activist investors, you did speak about them. There are some hedge funds that come on the boards, and then you start seeing better returns, or you start moving towards an ESG mandate. Let me switch the question to a more India-centric point of view. What can a retail investor do in this? I'm a retail investor. What can I actually do in terms of making a company move towards an ESG-focused mandate? And how can I ensure that the company and I'm speaking for a generic Indian here, or a generic retail investor, how can I ensure that the companies that I invest in engage in more sustainable practices?
The simplest answer, if you're a quote-unquote man on the street or the Aam Aadmi, is
I'm the Aam Aadmi, yes. Then
consumer demand. If you change the, assuming you have the resources to afford this is a big issue for sure. But if you change your product consumption tastes, meaning you want the greener, or it's because it's good for you, you're willing to pay a little bit more, and hence it's good for the company. Frankly, the consumer has far more power, I think, than the investor on the margin. So it's not even the investor. Now, if you talk about the investor per se, are capital flows going to make a very big difference? Maybe in the oil example that I discussed a little bit, the tobacco example doesn't matter at all. So this is a big issue. Even in oil, my worry is if you start, divesting away from oil, a lot of the high emission units will simply be sold to private equity, and then it'll just disappear. One more case of emissions perception management, right? So, if I had to pick between your ability as an investor versus your ability as a consumer, I would any day say it has to be as a consumer. But
consumers are price sensitive, aren't they?
No, that's a fabulous point as well. You ask somebody, you ask a mother, will you buy organic food for your baby versus generic? She will say organic. If you show them the price tags, it's like 90-10. The polling switches to 10-90 because prices are pretty much the only thing that we understand. Talk is cheap, as you know. and that's predicated on overall prosperity, which hopefully is happening, right? I mean, the per capita income is growing. Tastes will hopefully evolve. But as a retail investor, what can you really do? Frankly, the information intermediaries, in my mind, are simply not up to the job. The ESG ratings, which you're probably referring to, in my view, are just to put it politely, not even close to where they need to.
I wanted to ask about them as well,
Yeah.
Professor. A lot of ESG ratings seem counterintuitive. A lot of them are orthogonal in terms of the dimensions that they work in. How does the common investor make sense?
It is very hard. It is very hard. So, what do ratings do and what purpose do they serve, right? I think it's partly because the quants need a number that they can download and create portfolios from.
Yes.
And, when we utter the word ratings, we consciously or otherwise equate them to credit ratings.
Yeah.
Where the objective function is very clear. I'm forecasting one thing, default,
Yeah.
either for principal or interest, right?
Yes.
And even there, frankly, the track record of credit rating agencies is not stellar.
Yes.
Many of them downgrade the bond after the company is filed for Chapter 11 or insolvency, whatever the equivalent is in India. So even there, you could argue things are a bit shaky. And now you come to the world of ESG, where, this is another interesting thing as an aside. How did these things come together? So I went and looked. It turns out there's some UN agency which produced a massive report and stuck the words E and S and G together. That's how it happened, apparently. So obviously it came out of a bureaucratic UN report. But what is E? What is S? What is G? Well, E predominantly is climate. S predominantly is human capital. Maybe you could say, lobbying, political contributions, tax type stuff. G is relatively, hopefully, well known, right? But even that is messy. What is G? We don't know what boards do. Who's seen the minutes? And even if the minutes are kept, can we believe these minutes, right? So it's you need to understand the dynamic in the boardroom to understand how decisions are made, etc. So it's very hard to measure these things. That's point number one. Point number two, it's hard to define what these things mean. Point number three, I think the area is crying out for some focus. If companies came out and told me, here are the two stakeholders I care about, labor and say consumers, at least I can then begin to, construct some falsifiable ways to think about, are they doing a good or bad job? Right now, these sustainability reports are hundreds of pages long because companies are trying to please every stakeholder.
Yeah.
And then eventually it has to descend into greenwashing because you can't be good to everyone, right? Rating agencies are doing something similar. They are trying to rank people on all kinds of bizarre dimensions, which may or may not be important. How do you weight them? How do you aggregate them? There is no common unit called money, right? Which is why I'm a big fan of impact accounting, which is putting dollar numbers on these social values and so on. It is a mess right now. What do they actually do? So a lot of these guys run NLP, the natural language processing type things, where they're looking for negative news events. So Nike has a factory in Bangladesh example. Nike gets a bad point, So the underlying data is not there necessarily. There's demand for these ratings, but if once you open the black box, there are all kinds of worms.
Until then, we have rational voter ignorance, right?
Well, the sustainability reports are actually, well, again, I do this for a living. You can't expect a retail investor to do this, to kind of comb through. I mean, I'll send you my Coke thing. It took me a long time, by the way, to figure out what exactly Coke was doing. And B, most important, is the social impact. A lot of ESG is focused on the company's operations, right? What does that mean for impact on the environment, impact on some stakeholder group you care about is missing. So one thing you could add to the whole ESG paradigm is this idea of P, or product, meaning what is the product's impact on, say, the health of people. We talked about the diabetes example. What is it doing to water? For example, Coke says that it is water neutral. We've all heard of carbon neutral. I've never heard of water neutral. And if you dig deep, it turns out they basically, say suck out some water in Kerala and they replace it in Vietnam. How does that help anyone? So there's a lot of slippage in all these definitions and terms, which you will realize if you go through a sustainability report. So that's the primary data to me is the only way to get a feel for what to do. You have to, as an investor, impose focus. One way to start, maybe go through the risk factors. At least in the US, we have these risk factors in the 10K, where a company will tell you every tangential reason why they may get sued and they may get killed out of business. Maybe that's the way to keep your focus. Start with the risk factors, look for information in the sustainability report, not the other way around. The sustainability report is a noodle soup. So much information there, non-comparable, non-financially, sometimes relevant, sometimes irrelevant data points, etc. So maybe that's the other practical tip. Start with the risk factors. Think about sustainability-related data points that may help you. And then it becomes a pure risk management conversation.
No, I agree. I think this is a very good takeaway. One has to do that homework before one actually looks at the sustainability report and tries to make sense of it.
Yeah. The other way around is a mess. I read, there was something in Business Week today about how some whiz kid is kind of running NLPs on all these sustainability reports and finding ways to make money. I'd really like to see what they do. This is the other thing, trust but verify.
Yeah, absolutely.
The world is full of all kinds of stuff. Trust your own eyes and ears.
Let me go on to the next question now.
Yeah, sure.
This has been a fascinating conversation.
Oh, thank you. It's my pleasure entire.
The pleasure is entirely ours, sir. Do you think private financing in sustainability to be as potent as public financing? I mean, do you think a government impetus reduces the risk of such investments?
I
mean, you have been talking about you need a subsidy, but
I think it has to be a partnership, right? Each entity by itself can't get us to where we want to go, because if it is completely state-driven, the history of states using capital well is frankly not good. Right? I mean, the history is littered with examples where green stimulus, etc., just gets wasted, misdirected. There was a study, in fact, I wrote a piece on it, where the so-called green jobs in one of Obama's bills, somebody went and checked what happened there. What are the green jobs? They were basically waste management jobs. They're not really green jobs. So, and there's one more paper I was working on where if you look at the cost of a job, it's like $250,000 or $300,000 or something. It's like 4 or 5 years of the salary of a person who would have worked at the job. Just write them a check instead. Why are we spending $250,000 to create a green job? So there is that problem, no question about that. And that has to be carefully managed and looked at. But if you don't have subsidies, how do you deal with that internal combustion engine issue that you talked about to transition? Because eventually maybe the market will move. For example, California has said since 2030 they're only going to sell EVs, and so it gives companies a 10-year leeway, because the replacement cycle for cars is probably 11 to 15 years. The EU has said that. That's regulation. So if it is purely voluntary, will a GM or a Ford start worrying about Tesla? No. Tesla's market share is still tiny. I don't even pretend to understand Tesla's valuation, because effectively the market assumes that Tesla will sell every car in the US. Every car sold. It's just bizarre.
Sir, you have companies which have market valuations of over $100 billion without revenues, right? Company with Rivan, some company in the US.
Yes. There's so many.
They're way out there.
Part of it is also, if I may, a reporting problem. We have, in my mind, completely messed up the intangibles debate. 35 to 40% of US companies now report losses. And it's mostly because we're expensing it, internally created intangibles, R&D, human capital embedded in SG&A. And that is kind of crying out for a solution. Meaning some, so here is the, I've written again quite a bit about that. And just to give you one statistic, Amazon spends 42 billion on R&D, but devotes 300 words in its 10K discussing R&D. So if you don't put an asset on the balance sheet, it's considered immaterial. And to some extent, the pressure on anybody to look at that carefully is gone. The auditor says it's immaterial, it's not an asset, I don't care. Conservative accounting is good for me. The manager doesn't have incentives to disclose. What are they doing with this 42 billion?
Yes.
And it turns out some of that is just content. Content to me is not R&D. The shows that Amazon Prime has, it's like, so that's an example of how some of it is a reporting problem. Not all of it is a reporting problem. To go back to your earlier point, this. Exchanges have become much kinder with early stage companies. So a lot of firms that would probably be incubated in the VC world are now being publicly incubated. Which is probably not a bad thing necessarily, as long as you know what you're doing. The third issue, as you know, is cheap interest rates all over the world. May not be in India, but if interest rates in the US are virtually zero, and then this is bound to happen, right? If interest rates are virtually zero, people are desperate for yield, and they start betting. Especially pension funds, which have promised very healthy returns to their workers. We have to figure out a way to make that 7, 8, 9% per annum, right, with very little risk. So before you know it, you start buying some of these early stage companies. And of course, indexation, let's not forget. At least in the US, I think this is also something that's not appreciated enough. People are buying baskets of securities, not individual stocks.
Yes.
We have delegated far too much power, in my mind, to the person or the institution that comes up with that index. And once Tesla gets into the S&P 500, it goes up 7x, right? Because we are just buying the S&P 500. So a lot, that whole indexation idea and ETF idea, the world is getting ETFized. So, and we haven't understood the implications enough, in my mind. That has to be a factor.
I agree, but these are forces that are, they were sort of considered independent of each other, and now we notice that they have a link, and that link may not be as helpful as.
But nothing is independent; it's an ecosystem, right? I mean, people are smart. If there are two forces that are independent, there's an arbitrage. So you're going to get them linked at some point to exploit one versus the other, right?
I must ask this link question, Professor. I mean, when you say people are smart, and I sort of wanted to link it to what you said earlier in terms of recognition and awareness. What's the talent deficit on ESG, sir?
Oh,
what do you think?
It's a great question. At the fundamental level, we don't even have ESG bookkeepers. Somebody has to actually collect the data. So a lot of people are making these claims about net zero and so on. If you look inside, and I've worked with a couple of companies, there's not even a spreadsheet, let alone something ERP based, something with more controls. So certainly the internal controls, the quality of the data is a huge issue. So at that level, you need talent to start with. Second, a lot of people in the ESG investing world, in my experience, are people who have migrated from places like development economics. They're outstanding people, they've spent maybe years in Africa, helping out and so on. So they're very empathic people. They want to help, which is fabulous. But they don't necessarily understand business and economics. You can't write checks. It doesn't work. There has to be, this is the old classic saying apparently attributed to Jesus. You have to teach people how to fish. You can't give them fish, right? So there is that mental mindset adjustment that has to happen, if you want to call that a human capital deficit. The ESG development people have to learn or whatever, at least appreciate how business and economics works to some extent.
If I ask you to give a time span on this point, I mean, how long before some talent deficit will always be there, sir, but how long before we sort of meet? Today the gap is yawning, right? It's huge.
Markets are reasonably efficient, Tirthankar. I mean, virtually, Wharton has set up, I think they have 50 sustainability classes now from virtually nothing. Columbia, we have set up a climate school. It's probably unique in the country. There's no school dedicated to understanding climate. And this is, hopefully multidisciplinary. You have people from business, you have people from engineering, you have people from, anthropology, etc., cooperating and getting together. Maybe 10 years at most. Even that is too long. 5 to 10 years, the deficit will get bridged.
Emerging markets, of course, right? I mean,
say again.
10 years. You're saying 10 years in the US, but you need.
Oh, I see.
Several more years.
But that's again an opportunity. There must be ways that ISB, NSE, and others can collaborate and bring people to. See, this is the other thing, Tirthankar. This is something I've always said. The expat Indian community is dying to make a contribution, and I'm not exaggerating this. As long as you create platforms and systems for people to come back and just transfer knowledge, it'll easily happen. Seriously, because if I may say so, as a proud Indian, the brain power outside is phenomenal. The brain power inside is even more phenomenal in the country. Human capital is not our problem. It's just a way of we just have to figure out systems to harness that and channel the talent. For all India can actually be a very big net exporter of ESG human capital after the whole coding revolution. That can go on anyway as well.
20 years, but yeah, we will. I have to ask you, a must-ask question before I go on to the, in the interest of time.
Oh yeah, sure.
We've been getting some questions from the audience as well.
Oh, I'm blissfully unaware. I don't see all that, but that's probably.
No, we've gone 60 minutes and I actually 75 minutes, and I didn't notice now until I saw the time. Really, really nice.
Oh, that's nice. Thank you.
Great conversation. So, sir, this question you would have got 100 times earlier. How has the pandemic affected our sense of sustainability?
Oh, it's huge, from various standpoints. So let's start with the fun part of this conversation, right? So till the pandemic, the whole ESG trade was basically go long on technology, go short on energy. Because if you look at the ratings, that's how they line up and so on, whether it's right or not. So there's a whole separate conversation. In 2021, as you know, oil has probably tripled. So it'll be fascinating to understand how these funds spin their trading strategy. They can't get into oil because they say
green bubble, and before that the energy bubble, right? I mean, all of a sudden.
Exactly, and now there's an energy bubble because of post-COVID issues. But second, it's an empirical fact. The amount of money that's come into fund flows, sustainable funds post-COVID has just skyrocketed. So that's what gives me some confidence. This is an organic movement to some extent. Three, the demographics issue. The younger investors. For example, they put a huge amount of pressure on Colombia to divest its carbon investments, and this is being repeated in every.
You mentioned campus. Millennials earlier. These are
it's true because they are your future voters and your future citizens and future consumers. And 4, people have spent so much time at home. I mean, COVID's been a game changer. We can talk about so many other aspects, right? Work from home. How is that going to evolve? People have spent more time with family, which is wonderful in general. I mean, friends of mine wake up at 4 a.m. in New Jersey to do the commute to the street. They're never going to do it again because it's a tough life, despite all the money you make and so on. So it's the virus, whether we like it or not, forced lockdowns probably is not a bad thing. But here is a depressing news, sadly, Tirthankar, because it took that much to bring down emissions to about I think it probably fell by like 4 or 5%. It takes such a massive event and such a massive fall in GDP to cut emissions, which tells us how difficult this is going to be, which is something we've talked about, the IC issue and so on. But this is there's no doubt There's no doubt. When history is written, it's a landmark event that changed so many social, political, and hopefully some good, the whole the Zoom seminar, technological issues. That maybe this is the time when ESG came into its own. And I used to be worried
in a permanent way.
Yeah, that's the thing. I used to worry whether it's a fad or not. Will it just go away? I'm beginning to get more and more convinced it's probably not a fad. It's an organic movement, and despite politicians getting in the way, it's picking up. And let's keep it up. If you're thinking about both the product market, the consumer, and the investor, I have no doubt in my mind this is not going away. Investing. And we've talked about the limitations of ESG investing. What can you do on the margin as an investor? You can change preferences, etc. But in an efficient market, somebody is going to pick up that asset, claiming that it's undervalued, right? That'll evolve. That'll evolve, become better. Even some of the best. For example, I've spent a lot of time trying to understand the Swedish pension system. Because they are. I just want to see what does Greta Thunberg's country do, right? Just to check what. Even they rely almost exclusively on divestment. They sell high carbon assets. They don't necessarily probably have the clout to engage outside of Sweden. BlackRock, BlackRock's claim is that it owns the entire market. It has a very long horizon. So even negative externalities hurt BlackRock because let's say they hold oil and they hold somebody else downstream that gets hurt by oil, so they get affected. That's their at least theoretical claim for intervening. Actually, I've probably lost my chain of thought. Remind me again. What would we? The virus.
Yeah. Yes.
Yeah, absolutely. I think. Yeah, so you were asking whether it's permanent or not. Sorry. Okay, so I was just trying to respond to that. I don't think it's going away. I don't think it's going away. Partly because it's there for all of us to see, right?
Yeah.
The AQI issue, the haze, the smoke, the water, so many bizarre cases where like British Columbia, Vancouver, last month was underwater. It never happens in Vancouver at this time of the year. Australia has been suffering, one climate crisis after the other.
I think floods in Germany, floods in China.
Exactly. And that's an interesting point. A lot of that is actually being basically deficit financed away because you have to rebuild, and the state's picking up those costs. But eventually, the day of reckoning will come. In the sense that credit ratings for these municipalities, etc., have to fall. Cost of borrowing has to go up, or it has to get done by taxes. So, the point that's often underappreciated in this conversation, I think there's going to be a tsunami of climate-related capex spending that has to come, either at the state level or at the private level, or both, perhaps. So I don't think it's temporary.
I agree.
And I start as a skeptic, so hopefully I have a bit more credibility with you than a Pollyanna who's always said, ESG is like this wonderful thing.
No. I think you've been anything other than a Pollyanna because.
Well, I try to be balanced. Just follow the facts and the evidence.
I think for a layman, I think for us, the bad thing is that there's a lot that needs to be done, but the good thing is that we can start right away.
But awareness is the beginning. This human capital issue that you raised, yes, sometimes you feel like you're barking into a well. There's nobody there to listen, but in the long run, the impact will accumulate.
Let me now take the opportunity to go on to some questions.
Yeah, please, more than
have some. So one question is from Venkatesharlu Perry. One view is that, and I read, ESG investments are more prevalent and pushed by low interest rate economies with low inflation band. What's your call or opinion?
Well, we kind of alluded to this in the conversation, right? I mean, yes, I worry sometimes, if interest rates double, and if this administration changes in the US, what will happen? Some of the froth will disappear. I mean, some of the green bubble stuff is just hard to understand. I mean, Tesla's valuation is a good example, right? Even if Tesla sells every car in the US, it's probably not going to grow into this valuation. So, and remember, bubbles happen all the time. You can go back in 2001, it was whatever, Tesla.com or Tirthankar.com. Maybe this is the age of the green bubble. So I'm sure some of it is true. But is there no business case for this? Eventually, I think the Amazons of climate will come up. Maybe we need 20 more Teslas to solve the climate problem.
And valuations have a way of reverting to the mean, right? Mean reversion does happen at some point.
I'll send you a paper we wrote. It's fascinating. I find it fascinating. Here's what we did. We went back and looked at every IPO since 1970 in the US, and we asked the following question. Let's say you buy the entire company at the IPO price.
Right.
How long does it take for that capital to come back to you through some fundamental measure, like earnings or cash flows?
All right.
It's really interesting. It turns out only 20% of companies survive. The other 80 die. The only way to make money consistently is for your company to get bought, because somebody pays a control premium of like roughly 25-30% on that stock. And as long as you can pick up an IPO that gets acquired, you're in good shape. And out of the 20% that survive, there are companies that haven't returned the IPO price to the investor for 20 plus years, even after you account for intangibles and issues like that. So, maybe the cynical take on that study is that we're probably exchanging pieces of paper anyway. The fundamentals are there somewhere in some theoretical way in terminal value, and who's kind of seen that, and our horizons are like 2 years, and we just kind of flip, etc. So you can say that for the entire stock market at some level.
Professor, we need an entire conversation on valuation, on index.
Oh, sure, we can. Let me send you some work, and we can structure something around that as well.
Yes, please. We would be. I know the topic of this investment had a lot to do with ESG. This topic webinar had to do a lot with ESG. But I kind of believe that there are a lot more interesting conversations that we could have with you, sir.
Oh yeah. See, this goes back to the human capital idea. If somebody understands accounting and numbers and migrates to this ESG world, I think that's a slightly better perspective than the other way. The development people trying to come to this, because this is true universally, Tirthankar. All the data scientists I've seen, they're brilliant at data science. Except to them, pressure, mass is probably the same as cost of goods sold and depreciation. They just don't know. They don't understand business and context. So there is value to kind of pairing the specialist with somebody who has some domain expertise. And sometimes that doesn't happen. Wall Street is always into the next fad.
Yeah.
So I can go on and on. For example, they brought in a bunch of physicists who said, "Oh, this is all trivial. We kind of model stuff in space." And in 5 years, the fund lost money and they shut shop. So figuring out markets is much harder than figuring out, maybe even launching satellites.
Yeah. My next question is from Tirthankar Patnaik. Which industry will be impacted more due to ESG in the long run?
Negatively, it has the obvious ones are, oil. Positively, obviously, battery technology, solar, renewables.
IC automobiles.
Right. Oh, yeah. Construction, cement, shipping. Those are the high emissions industries. Automobiles. And construction in a positive way, because you have to keep reconstructing as well once the floods destroy. So it goes both ways. So let's rephrase that question. Are there industries that will not get impacted? Right? Maybe technology is positive, right? Maybe some version of work from home is maybe the clever way to manage emissions.
Yeah.
Right? Do we all have to go to work? Maybe we don't, right? But that's going to create its own issue, right? So people who don't show up to work are probably the ones who probably not get promoted. Human beings, we are hardwired socially in a particular way. To change that instantaneously is going to be a stretch.
It would indeed. Sir, there are no further questions here. And this has truly been a fascinating conversation, an exhilarating conversation, sir. I mean, we are truly thankful, really thankful to have discussed so many topics with you. I mean, I think the perspective of bringing accounting into ESG, about talent deficits, the case study that you mentioned on this beverage company Coke, and how we can make a difference, and how reading probably the risks, as I'm trying to recall the risk statements of a company rather than reading their sustainability report. There are so many takeaways that one could actually have from this conversation. Thank you, thanks a lot.
Oh no, it's entirely my pleasure.
Really been a pleasure.
No, seriously, Tirthankar, the questions were superb. I had lots of fun. And if I wasn't insightful enough, I'm going to blame jet lag. But I look forward to doing this some other time with you as well.
We certainly look forward to hosting you some other day, and online is easy. Online is
certainly, of course.
But as I mentioned earlier, it would be our pleasure indeed to have you here at NSE. Speak to our audience.
Oh, thank you. I really had a great time. Thanks to ISB, Prasanna, Ravi, and to you, Tirthankar. It's been fabulous.
Thank you, Professor. I thank ISB. I mean, I thank Anand. Anand, you're on there. If you could switch on your video if you're there, I really want to thank ISB. I want to thank our marketing department at NSE, Mihir Moge. He's also around. So it's been a pleasure, and ladies and gentlemen, we've come to an end of this conversation on ESG. You might be hearing several conversations on ESG, and in every conversation, think about a distribution, and one is typically near the mold. This is one where we were near the tails. So
hopefully the right tail.
The right tail, absolutely the right tail, Professor. Absolutely the right tail. I really want to thank you from the bottom of my heart for this.
Oh no, it's my pleasure to get to know you, at least maybe just virtually, but hopefully we can catch up over a meal or something someday.
Please, it will be our pleasure. It will be absolutely.
Thank you, Tirthankar. Thank you, Anand and Ravi and Prasanna, who's not on the call, for making this happen. I really had a great time. Thank you.
Thank you, everybody. Thanks, Professor. Thanks, Anand.
Take care.
Thank you all. Thank you for joining in.
Thank you.
Recording stopped.